Hello, friends. Today we're talking about advanced auto parts, ticker symbol AAP. This stock has been beat up really bad this year. In the last month, it is down 3%, but it was down almost, I think it's like 10%, if not a little bit more. It has been recuperating. Year to date, it's down 61%, and in the last 5 years, it's down 68%. It had been trading before, um, somewhere between 130 to 150 or 60 before a big rally before the during the pandemic and the year afterwards. So since then, it has come down from $239 to $56. Analysts are putting a price in the next 12 months to get to $75, which is not super crazy. It's kind of what it was trading the first half of the year. Well, not the first half, between June and September. So that will be an upside of 26%. They did reduce their dividend. A lot of people love this company because of the dividend, and they reduced it to about $1, which is a 1.78%, for those that like dividend. They just reported on last month on November 15, and I listened to the call, and we'll be talking a little bit about that. In their call, they missed a lot. They completely missed. They were expected to be positive, about $1 something, and they actually registered a loss at 0.82 82 cents of EPS for the quarter. They did beat in revenue. I know that one of the things that they have been going through is, there's a new CEO, I believe, and he has been going through. His name is Shane O'Kelly, I believe, and he has been trying to look at cost reduction. Whenever you look at the financial statement, they are spending a lot of money. Parts and things have gone up, so they are not making money. They're looking. One of the things that they're doing is they're expecting to. They started a new program to reduce cost. They're hoping to save about $150 million and use 50 millions on that to retrain or to focus on improving on retention of the team members. Remember, Advanced Auto Part, for those that don't know, is a company that sells auto parts. And one of the things that you want as a customer whenever you go to Auto Part or Rallies or AutoZone is the people in front to know about cars. So one of the things that he was talking about is that they did let a lot of people go a couple of months ago, but they're trying to retain those members that are knowledgeable, that they're good, and they're going to try to use some of this money to probably pay them more and give them more benefits so that they can stay a little bit more. The other thing that they are thinking to do is Autopart owns Worldpac in Canada, and they are thinking about, they're looking to see if they could sell it. They're exploring ways in which they can uh, generate some cash by selling that company. It seems like when I was listening to the earning call that there was a lot of Worldpac already works very separately from Auto Advance, and it just feels like they're doing a lot of the same things, and that's where a lot of the cost issues are happening. And one of the things that they're going to try to do, what the CEO was talking about, was trying to focus more on their basic business. With that said, we're going to jump into or financials. Just to remind you, this is just for educational purposes. I'm just sharing with you guys what I think about this stock. I am not a financial advisor, and I do not recommend that you follow my advice. I just want to share my thoughts with the community, investing community, and I would love to hear your comments. So please subscribe and leave a like or a comment telling me why you agree or disagree with me. Do you think that AAP is going to stay where it's at, or is going to jump to the 70 something dollars that analysts are thinking, or even more, back to the 160s that it used to trade at? This is a very cyclical company, but they have been doing really good. They have been growing their earnings for about 7.8% a year, consistently in the last 5 years and 10 years. Their earnings have been a little flat. Lately, this year has been low, but before this year, as you can see, it had stayed very flat, growing a little bit. So from 5 to 7, somewhere around there. Profit margins, this is the biggest issues that they have. Their average right now is almost 5%, but historically, they have been, their profit margin, it's the return of invested capital of equity, sorry. It has been at 7%, but historically it has been in the middle 10s%. When it comes to free cash flow, they're negative for the year. Once again, it has been a little bit up and down, staying somewhere around the $5. So that is something to consider. The free cash flow margins is 6.4%, and I believe the other competitors like AutoZone or O'Reilly's, they actually have larger margins. So that would be a reason why maybe look at them instead of Advance Auto. The reason why I'm looking at Advance Auto is because of the possibility of a possible value. But I'm trying to figure out if it's a value trap. Book value has been growing about, in the past 10 years, about almost 8%. In the last 5 years, has been going down for about 1.5%. Return on equity has been close to 14%, average in the last 5 years, 4.33 in return on assets, and 8.7 in return on invested capital. This will be good numbers to look if you are thinking what might be the bottom for AAP. Normally, a book value is a nice indicator of how low a company can get. So I could get down to $40 to $44, and those numbers can change depending on the assets and liability. Dividend, they were paying a consistent 22 cents. Then in 2020 started to really bring the dividend, and I can mention before, they have dropped that down to $1. Their debt has been growing, and this is another issue that they have. This is part of the reason why they're looking at maybe selling the company. They either have to bring selling what was that company called? Worldpac, and that is something that they need to, because right now, if they continue to be producing the 5-year average of free cash flow, it will take them 10 years, which makes it a little risky. I normally look for under 5. So they need to either pay down the debt or bring their free cash flow a little higher. When it comes to shares, they have been buying back shares in the past 10 years, an average of 2%. In the last 5 years, about an average of 4%. So whenever we put everything together, analysts are actually still considering that they might continue to struggle in the next 5 years to grow earnings and free cash flow. So that is a little negative. I don't know how much stock you put on the analyst. So that's why at least I do my own valuations. So whenever you put all the numbers together, you take the average of the last 5 years in revenue, earnings, free cash flow, and book value. I will not be using the dividend because it has been so over the place with the cuts and stuff. And you multiply that by the median of the 10-year multiples. You get a fair price somewhere between 115, 116 in the trailing 12 months. If we go back to the average multiples or the median multiples, and 172 if we look at the average per share numbers that they have been doing, which will be a big swing of numbers from now. Payback time, we're looking at right now they're negative, so I'm using a negative 1% growth of rate. If they were not to grow, if just to stay like that, the fair value of the average free cash flow, if they could get it back to there, it would be about $102. And when we're looking at a growth rate of 1% and selling at the 20p discounted earning, growing those earnings for 5 years at 1%, then discounting them back, it will be somewhere between $32 to $70. Using the owner's earnings valuation, we will be looking at somewhere between $200 to $25. That is a big swing. So whenever we're looking at the free cash, all the fair valuations together, and if you want to play with them, you can go to my there's a link in the description down there, and you can download this sheet so that you can play with the numbers. I personally will not be using the trailing 12 months. I have put a 55% margin of safety, and that will give me if I put the average, it will be about a $50 buy time, buying entering, since the average number will be the average fair price between these two numbers will be somewhere around $112. But even if we look at the fair value with all how beat up it has been, we're even looking at $75, which is what analysts are thinking. So if you were to put a 50% margin of safety, that will, I believe, put you in a buy right now, somewhere around 56.34. So I hope that you enjoyed the video and hope to see you next time. Make sure that you leave some comments and let me know how I did. Bye.